Ladies and gentlemen, today we dive into a topic that shapes every financial journey. Whether you're a beginner, a student of markets, or someone simply trying to build a secure future, we're talking about five major asset classes, the building blocks of wealth, and what history teaches us about their performance, risks, and long-term behavior. Understanding asset classes isn't just for investors. It's for anyone who wants clarity, confidence, and control in their financial life. History does not repeat perfectly, but it often rhymes, and if we pay attention, it gives us valuable lessons. So let's break down these five asset classes in a simple, practical way: equities, bonds, real estate, commodities, and cash equivalents. Each one reacts differently to inflation, recessions, global events, and technological change. And when you know how they behave, you make smarter choices, not emotional decisions. Equities have historically been the most powerful driver of long-term wealth creation, and their performance across more than a century proves this repeatedly. When you invest in stocks, you're not just buying a digital number on a screen. You're owning a piece of real businesses that produce goods, services, innovations, and solutions that society depends on. From early industrial companies in the 1900s to today's technology giants, equities grow as companies earn profits, expand operations, and adapt to changing times. Across global markets, despite countless downturns, including the Great Depression, world wars, inflationary spikes, oil crises, recessions, and financial meltdowns, stocks have shown a powerful pattern: short-term volatility but long-term upward momentum. Historical charts make this extremely clear. While the market may dip sharply for months or even years, it has continually recovered stronger than before. This upward trend is driven by productivity growth, population expansion, innovation, and rising corporate earnings. Another reason equities outperform over time is the effect of compounding. When companies reinvest their earnings, or when investors reinvest dividends, the growth accelerates exponentially. This compounding effect, supported by decades of historical data, is why long-term equity investors often see significantly higher returns than those who rely on more conservative assets. Equities also benefit from economic progress. As industries evolve: manufacturing, energy, technology, healthcare, finance, companies that innovate gain value and shareholders gain with them. Every major technological revolution, from electricity to the internet to artificial intelligence, has boosted the long-term trajectory of stock markets. While equities are sensitive to market psychology and global events, their ability to rebound is unmatched. Investors who remain patient and avoid emotional reactions typically benefit the most. History is filled with examples of markets bouncing back with new highs after every crash, often faster than people expect. The historical lesson is clear: equities reward those who stay consistent, diversified, and focused on long-term horizons rather than short-term noise. Bonds have historically served as the foundation of portfolio stability, acting as a financial cushion during periods of economic stress and market turbulence. Unlike stocks, which can rise or fall quickly based on market emotions or global events, bonds provide a more predictable stream of income through fixed interest payments. This steady flow of income is one of the main reasons bonds have been trusted by governments, institutions, and individual investors for centuries. Government bonds, in particular, have a long record of safety because they are backed by the financial strength and credibility of national governments. In times of crisis, when stock markets are crashing or investor confidence is shaken, money often flows into government bonds as a safe haven. This flight to safety effect can even cause bond prices to rise during market downturns, helping offset losses from other asset classes. Historical data shows that during major recessions, such as the 2008 financial crisis or earlier economic slowdowns, bonds provided crucial balance, helping portfolios avoid deeper losses. Another important aspect of bonds is capital preservation. While they may not deliver high returns like equities, they shine in their ability to protect the original investment. Corporate bonds, municipal bonds, treasury bills, and long-term government securities all offer varying levels of safety and return, giving investors multiple choices based on their risk tolerance. Lower-risk bonds typically offer modest returns, while higher-yield bonds offer more income but with increased risk. Bonds also play an important role in smoothing out the volatility of a portfolio because they often move differently from stocks. Adding bonds creates diversification, reducing the sharp ups and downs that come with an equity-heavy approach. This balance becomes especially valuable for investors approaching retirement or those who prefer consistency over aggressive growth. Historically, bonds have also been reliable during deflationary periods when the value of money increases and interest rates fall. During such times, bond prices usually rise, benefiting investors who locked in higher interest rates earlier. In contrast, during periods of rising interest rates, bonds may lose value, but the steady income they generate still helps counter inflationary pressure. Overall, bonds have proven to be a dependable component of portfolios because they offer stability, predictable income, and protection when markets become unpredictable, allowing investors to withstand economic cycles with greater confidence. Real estate has historically been one of the most reliable and tangible asset classes for wealth preservation and growth. Unlike financial instruments such as stocks or bonds, real estate represents a physical, usable asset. Land, residential properties, commercial buildings, or rental units, which often holds intrinsic value regardless of market fluctuations. Over the decades, property has consistently demonstrated the ability to appreciate in value, especially when carefully selected in growing locations, urban centers, or areas with strong economic activity. One of the key advantages of real estate is its role as a hedge against inflation. When the general price level rises, rents and property values tend to increase as well, preserving the real purchasing power of investors' capital. Historically, during periods of high inflation, such as the 1970s or during certain emerging market booms, real estate outperformed many other asset classes by maintaining its value and generating steady income. This dual benefit of appreciation and cash flow makes it a particularly attractive long-term investment. Real estate also offers multiple streams of potential returns. Investors can earn rental income, benefit from property appreciation, leverage financing to amplify returns, and take advantage of tax incentives offered by governments. Rental income, in particular, provides a stable cash flow that can help offset other investments' volatility. When strategically managed, real estate can be both an income-producing asset and a long-term growth vehicle, making it a cornerstone of many diversified portfolios. Another historical advantage of real estate is its relative independence from short-term market cycles. While property markets experience fluctuations, they are generally less volatile than equities. This slower-moving nature allows investors to make long-term decisions without being swayed by daily market noise. Over centuries, even as financial markets crash or currencies fluctuate, land and property have retained inherent value, often outperforming other asset classes during turbulent periods. Real estate is also deeply tied to demographic and societal trends. Urbanization, population growth, infrastructure development, and technological hubs all drive property demand. Investors who study historical trends and plan strategically often find that property in high-demand areas appreciates steadily over time. Furthermore, owning physical assets can provide psychological security. The tangible nature of real estate gives investors confidence that their wealth is backed by something real, not just numbers on a screen. Lastly, real estate has historically proven resilient across different economic conditions. While no investment is risk-free, careful selection, long-term holding, and diversified property types can provide protection, income, and growth opportunities simultaneously, creating a solid foundation in any diversified investment strategy. Commodities have historically played a unique and vital role in investment portfolios, primarily serving as a hedge against inflation and market uncertainty. Unlike financial instruments, commodities represent tangible goods such as gold, silver, oil, agricultural products, and industrial metals, resources that hold intrinsic value across time and geographies. Their prices often react differently than stocks and bonds, making them a critical diversification tool that can protect investors during periods of economic stress or currency depreciation. Gold, for example, has been considered a store of value for thousands of years, consistently retaining purchasing power even through wars, hyperinflation, and financial crises. Its historical role as a safe haven asset is unparalleled. During periods when stock markets plunge or currencies lose value, investors flock to gold to preserve wealth. Silver, platinum, and other precious metals exhibit similar behavior, often moving in response to supply-demand imbalances, geopolitical tensions, or industrial needs. Commodities are also closely tied to inflationary pressures. When the cost of goods and services rises, commodity prices tend to increase as well. Historically, this correlation has allowed investors to hedge against the eroding purchasing power of cash or fixed income assets. For instance, during the oil crisis of the 1970s, commodity prices soared, protecting those who held tangible resources while financial assets struggled to maintain value. Beyond precious metals, industrial commodities like copper, aluminum, and agricultural products also respond to economic cycles. During periods of industrial growth and urbanization, demand for these resources rises, driving their value upward. Conversely, in times of economic slowdown, their prices may decline, but their inclusion in a diversified portfolio helps reduce reliance on traditional assets like equities and bonds. Commodities behavior is often independent of traditional market correlations, which makes them especially valuable in risk management. While they may not generate income like stocks or bonds, their ability to appreciate during market turbulence or inflationary periods provides a critical layer of protection. Investors who include commodities in a portfolio historically benefit from their counter-cyclical performance, using them to balance the volatility of other asset classes. Additionally, commodities are influenced by global factors such as geopolitical tensions, climate events, technological innovation, and trade policies. These dynamics create opportunities for informed investors who track historical patterns, supply-demand trends, and macroeconomic indicators. Over centuries, commodities have consistently demonstrated resilience as a protective and strategic component of wealth preservation strategies, particularly during times when traditional financial markets face heightened uncertainty. Cash and cash equivalents, such as treasury bills, money market instruments, and highly liquid deposits, have historically been the backbone of financial safety and short-term stability. While they may not provide the high returns associated with equities or the appreciation potential of real estate, they play a critical role in any well-balanced investment strategy. Their primary value lies in liquidity, flexibility, and capital preservation, ensuring that investors always have immediate access to funds when opportunities arise or emergencies strike. The most apparent advantage of cash is its unparalleled liquidity. Unlike stocks or real estate, which may take time to sell or convert into usable funds, cash is immediately available. This feature allows investors to respond quickly to market opportunities, such as buying undervalued assets during a downturn, or to meet urgent financial needs without being forced to sell other investments at a loss. Historically, those who maintain a portion of their portfolio in cash have been able to capitalize on market corrections, purchasing assets at discounted prices when others are constrained by illiquidity. Cash also serves as a risk reduction tool. During times of extreme volatility, economic crisis, or market crashes, cash provides stability and peace of mind. While its value may erode slowly due to inflation, it does not experience the same daily fluctuations as stocks, bonds, or commodities. Investors with significant cash holdings are less exposed to market shocks, allowing them to remain patient and avoid panic-driven decisions that could harm long-term wealth. Another historical lesson about cash is its role in portfolio rebalancing. Because it can be deployed quickly, cash enables investors to adjust their asset allocation in response to changing market conditions. This strategic flexibility allows for better management of risk and opportunity, creating a foundation for long-term growth while mitigating short-term exposure to losses. Cash equivalents, such as short-term treasury bills and money market funds, also offer a modest return while maintaining safety and liquidity. These instruments have historically provided better protection than keeping physical cash idle, and they act as a buffer during periods of uncertainty. Additionally, in a well-diversified portfolio, cash can enhance overall returns by allowing investors to strategically deploy it into higher-performing assets when market conditions are favorable. Finally, cash represents psychological security for investors. The knowledge that a portion of wealth is instantly accessible reduces anxiety during market turbulence and allows for more rational decision-making. Historically, this ability to remain calm and opportunistic during crises has been a defining characteristic of successful investors, demonstrating that cash, while not the most glamorous asset, is essential for financial resilience, strategic flexibility, and long-term wealth preservation. Diversification has long been recognized as one of the most important principles in investing, often referred to by experts as the only free lunch in finance. Historical analysis across centuries of market data clearly shows that no single asset class consistently performs well in every economic environment. Stocks may soar during periods of economic expansion, while bonds may provide safety during recessions. Real estate offers tangible value and inflation protection, commodities hedge against market shocks, and cash ensures liquidity and flexibility. By combining these asset classes in a single portfolio, investors can balance risk and reward in ways that no individual investment can achieve alone. The concept of diversification is not just about spreading money across different assets, it is about carefully selecting investments that behave differently under various economic conditions. For example, during periods of inflation, commodities and real estate tend to perform well, while cash loses purchasing power. During deflationary periods or market crises, bonds and cash provide stability, cushioning losses from equities. By mixing these assets strategically, investors reduce the likelihood of severe losses and improve the overall risk-adjusted returns of the portfolio. Historical data reinforces the effectiveness of diversification. During the Great Depression, portfolios weighted heavily toward equities suffered catastrophic losses, while those including bonds and other conservative assets fared far better. Similarly, during the 2008 financial crisis, diversified investors who held a mix of stocks, bonds, and cash were able to weather the downturn more effectively, maintaining stability while others faced near-total losses. Over the long term, diversified portfolios have historically delivered smoother returns, reduced volatility, and preserved capital more effectively than concentrated investments. Diversification also includes geographical and sectoral allocation, not just asset class selection. Investors can spread exposure across different regions, industries, and types of financial instruments to further reduce correlation and improve resilience against localized economic shocks. For instance, investing in global equities can balance the impact of a recession in one country, while exposure to multiple industries ensures that sector-specific downturns do not devastate the entire portfolio. Moreover, diversification is a dynamic, ongoing process. As markets evolve, asset values shift, and economic conditions change, the optimal mix of assets will also shift. Regular portfolio rebalancing ensures that diversification remains effective, taking advantage of growth in certain areas while mitigating risks in others. This continuous adjustment, informed by historical performance and forward-looking analysis, strengthens the portfolio's ability to endure uncertainty and capitalize on opportunity. Finally, diversification is as much about psychology as it is about numbers. Knowing that investments are spread across uncorrelated assets allows investors to remain calm during market turbulence, avoid panic selling, and make decisions based on strategy rather than emotion. Historically, this disciplined approach has been a hallmark of successful investors, highlighting that diversification is not merely a technique, but a mindset that underpins long-term wealth creation. In conclusion, understanding these 5 asset classes: equities, bonds, real estate, commodities, and cash, and the power of diversification is not just an academic exercise. History has shown us their strengths, weaknesses, and behavior across different economic cycles. By learning from the past, we can make smarter decisions, protect our wealth, and build a portfolio that is resilient to uncertainty. Remember, investing is not about chasing quick wins, it's about consistent, informed, and patient decision-making. Combining knowledge, strategy, and discipline will help you navigate markets with confidence and take control of your financial future.